Okay, welcome back, everybody. So here's the funny thing. Everybody is looking at mortgage rates and they're just freaking out. The question is, are mortgage rates going to quit freaking out between now and, let's say, the end of Q1 of 2025? Hang on a second. Let's find out. All right. So here's the funny thing. We've got the Feds that dropped the rate again, a quarter percent, but, rates went up. CPI numbers actually came down where they should be this week, met expectations, but yet rates didn't really come down. And we've got some good employment numbers as far as what should bring rates down. Rates didn't come down. The new president has been selected. I can't use the E word because, well, they ditched my last video because they said I was advertising for the elections. Who would have thought? Anyway, I wasn't, but nonetheless, we got to be careful of those words. So no E words this week. What we're going to talk about this week is one of the biggest factors with mortgage or with real estate is mortgage rates. And how does it impact it? How is it impacting those numbers? We're going to go through the metrics each week, excuse me, of the velocity and pricing. And is our market still really healthy? We're going to talk about new construction. Then we're going to talk about bank-owned or REOs. We're going to go through each one of those as we do each and every week, single family only. So with that, let's bring this in. So here it is, the newsletter that came out on Friday for our, as far as what interest rates are doing and how it's affecting the real estate market. You can see, look, hey, interest rates are still freaking out. The dip you see in the chart there, that's the dip of when that turnaround or the dip is when the Feds reduced the rate by 0.5 point. Everybody was super excited. We keep telling everybody, hey, be very careful because the Feds don't control mortgage rates. They control your car loan interest rates, your credit card interest rates, your home equity line of credit or a HELOC, what banks lend to each other each and every day. And people say, George, why do you say that each and every week? Because I get asked every single week. Well, the Feds dropped the rate 0.25% last week. What the heck? Rates should have come down. Why did they go up? And we talk about that they don't control them, but they affect mortgage rates. Mortgage rates are publicly traded on the internet, or not on the internet, well, I guess technically, on the stock market, right? Okay, so when we come in and then we start taking a look at what do the Feds say? And when the Feds talk, that's super important because the Feds can absolutely drive the industrial investors in or out of bonds or treasuries or whatnot, which again will affect mortgage rates. All right, so let's talk about this. So Fed Chair Kashari says, hey, man, he's confident with inflation. May take a year or two to achieve the 2% goal. If inflation surprises to the upside, that could affect, the Fed rate cuts. Schmidt says, hey, listen, man, things are a little too early to tell. If things kind of stay the way they are, we're going to stay the course, might do a cut or two, not 100% sure. Fed Logan. He's saying this says, hey, man, we're seeing signs that the Fed may not need to cut rates as previously thought because it seems like things are just slowing down a little bit. Hey, maybe the 2 cuts that we did was just enough. Then we have Fed Musalem says, hey, man, look, there's a sense of higher inflation. Risk is is the sense that I'm kind of feeling. Data since the last meeting suggests the economy may be stronger than expected. Then we have Fed Powell, the one that you normally hear. He's the guy you normally see on TV. And he says, hey, man, the economy is sending signals that we don't need to be in a hurry about cutting rates. Expect inflation to continue towards 2%, and that is our goal. So, excuse me. That is a super important message to understand because, as you guys have seen, every time the Feds cut the rate, mortgage rates go up because mortgage rates are, mortgage-backed securities, bonds, those are publicly traded. They indicate where things are at. Industrial investors respond or react to it depending on what they're doing. So the other part is we need the Fed rate. Actually, I know this seems kind of strange, and some people are going, no. Yes. We actually need the Fed to keep those rates just a tad bit higher, a little bit lower than where they're at, okay? But we need to keep them higher. We absolutely cannot go down into the zeros because then we're lending money at a loss. And we cannot be doing that. We need, as an economy, to remain wholly healthy to keep that going. Selfishly, yes, we want the everything to come down. We want mortgage rates to come down because then we can get in at lower cost. We see a lot of transition, but there's a lot of debt that the feds cannot pay for at that point, and that is bad. So there's going to be a little bit of changes. I think there's going to be quite a few changes happening this presidential cycle. Hopefully it will end up for the positive. We just never really know. We can always be hopeful. I am always hopeful. I'm the glass is half full. All right, moving on. All right, so when we talk about what's going on in the news, right? So here we go. Mortgage rates roughly unchanged yet despite bond market losses, what we just talked about. The one just below it, mortgage rates jump back above 7%. Yes, they did bop up a little bit higher based on the fact that we didn't get quite the information they were looking for. And then, of course, bonds did not rally at all. They actually went down. The 10-year Treasury went up. And you can see on the red chart on the upper right how that is happening. So that's a real bummer. Bottom right, that's the mortgage calculator. Listen, there's a couple of calculators on that page. They're free. There's no login. There's no nothing. Go play with them. Put your numbers in. Especially if you're looking at doing a refinance, which a different video, we're going to talk about predictions for 2025 so far since 2008. I got about a 98% accuracy. So we'll see what happens, right? Anyway, moving on. Okay, so as we take a look at what's going on, let's take a look at Freddie. So funny enough, Freddie is that lagging 7-day running average, and they're at 6.78. That's what the news said. I was watching Fox News just the other day, I should say a snippet of it. That's the Fed rate or the mortgage rate that they pulled, which is accurate for the Freddie. Understand, again, being very clear, okay, that is a good metric. The red chart that you saw just before, that's a metric that shows what's happening on a day-to-day basis. Freddie, he kind of balances those out. Same with Fannie and whatnot. If you guys watched a couple of series ago, we talked about mortgage rates. U.S. News quoted Fannie Mae, Wells Fargo, and the Mortgage Bankers Association. They supported what we've been saying since August. And so I think that that's a good sign. At least other people are drinking our Kool-Aid. Oh, wait, they didn't call me. Oh, they should have. Anyway, we'll keep an eye on that one. But let's get back to it. So the key thing is when we take a look at what's going on and we talk about days on market, the left-hand chart, we're up 3 days year over year. And then, of course, when we take a look at the sales price to list price ratio, you can see that year to date we're at 99%. And some of you might say, George, what the heck does that mean? That means if somebody lists their home, let's say at $1 million, okay? I'll even make it simpler, $100,000, okay? And they sell that for $100,000, that's 100% of list to sale price. Now, if they, in this circumstance, they listed for $100,000, they sold it at $99,000, okay? That's a 99% list to sales price, okay? And that is where we're at today. And we've been bobbling between 97 and 99, 100%. We did not really go over in the prior year. We went over, but a lot of that has to do with rates because as we start taking a look at the velocity of the Northwest MLS, the chart on the right, let's go ahead and blow that up. Okay, so as you can see, we've had basically about 800 homes that came on market. Okay. And then, of course, pended, we had 1,145 homes that went pended. And you might say, well, okay, George, what is important about that? What we're talking about, we're still seeing this number of homes come on market. We're seeing this number of homes going off market. Okay, so we're drawing down our inventory, which is seasonally normal right now. Not a lot of people are coming on market. In fact, we're going to see a significant drop off of homes coming on market after the Thanksgiving weekend through the end of January, which at that point then is also the best time for buyers to jump into the market. Sellers are a lot more negotiable. Sorry, sellers, I know that's the case. If you're a first-time home buyer or you're a move-up buyer, now is the time to consider making that move. We still have rates that are still very competitive. Most companies are looking at, 6.75-ish as far as rate, 6.85-ish as far as rate. So you're still in the sixes. And a simple buy down, sure, would I? Probably not, because I think 2025 we're going to see the low sixes and about 5.75. And when we take a look at our numbers and we see that we are actually quite balanced, we're not seeing heavy swings. And in fact, so if we pop over, let's take a look at this. There we go. Don't forget, make sure that you hit the like button. Let YouTube know that, hey, man, we give you guys good information, right? Okay, so when we talk about velocity, we talk about what's going on. When we talk about the average price sold, okay, so right now we're up at about 8.4% year over year for the month of November. The month of November over each other, we're up 6.9%, almost 7%. And that's a big number when we talk about year over year, because it's a little bit more dynamic. And I pay attention to that one a little bit more. The year to date just kind of averages everything out, right? Here, we're kind of taking a look at what did each month do individually, and is it consistent with our seasonal normal? And here we are seeing that it is actually a tad bit more aggressive, because remember, last year, this is super important. So last year at this time, that's when rates started coming down. Remember, we were up almost in the eights last year at this time, right? Well, okay, a couple of weeks ago, we were almost in the eights. Now, they had just come down into the low sevens, high sixes, and people were like starting to get a little more active. And that chart, and if I were to, well, let's just rewind back to that. Okay, hang on a second here. So if we come back, right, and we pull that chart, which is right here, and let's open that up. Okay, so where you see that circle on the left-hand side, that's where we were at last year. Now, granted, we've been about 0.66, we've been 1% lower than where we were at last year consistently for a long time, but that's because we were almost in the eights. Now we're basically about 0.66 lower year over year. And you can see the circle on the right where we're at today, the circle on the left, that's where we're at last year. And you can see how we started that downward trend into November, into December, and then it started its upward chug in February, and then of course in the spring it chugged, right? Anyway, so as we roll along and we take a look at that, okay, here's what it boils down to. Let me open up this chart. Oh, there, you got it already. Okay, so we have no change since November 1st when we talk about as far as the dollar, the average sold price, okay? And when we take a look at it for month over month for the same month, I guess it's year over year for the same month, you can see that we're up about 13,000 since November 1st. However, quite a bit higher, well, to be exact, 6.9, almost 7%, almost year over year. And that's super important, because what we're looking at is what's happening year over year, because last year rates were coming down, and that's going to be very consistent for where we're at right now. So now we're going to see, hey, how close to that very nice market, nice velocity, and is it going to carry through the holiday season like it did in 2020 and 2021, our outlier markets? Or are we going to see seasonally normal that after Thanksgiving, 2 weeks from now, that we're going to start to see that taper off until the end of January? Super interesting. Here's the funny thing, pre-prediction of 2025 video, I think that we're going to actually start to pick up a little bit of momentum, especially if rates come back down into the low sixes. 2025 heading into the high fives. And I think then we're just going to absolutely see a drawdown on inventory. We're going to see a lot of that pent-up buyer demand. People on the sidelines are definitely going to come out. So now, if you want the best pricing with sellers, now's the time. All right, that was a long way to get around to, hey, it's a good time for sellers to buy. All right, so let's come back to this chart. Here we go. Hang on a second. So, that didn't work. That works. All right, so we talk about overall volume. Okay, so number of sales, closed sales is up 2,000 year over year. 2,000 homes is quite a bit. This is 3/4 of Washington State. Interestingly enough, we're up 3,000 homes that have gone pended year over year. Basically, for the month of November, let me curl this over and make it a little bit bigger. For the month of November, we're up 688 homes this November over last November, and it's only the 17th. And part of that is a lot of builder incentive, and we're seeing sellers come into the market correctly, which is super, super important. We are, yes, again, as we've been saying since September, October, we're definitely in a more balanced market. And, for the number of homes coming on, number of homes going off, neither one of them are an extreme. And that's super important. Let's talk a little bit about new construction. New construction itself, funny enough, is actually they're ramping up the sales game. Take a look at some of these. So naturally, we got our year-end sale. That's the red tag sale for a lot of sites. You've got basically a 4.99 or 5%. It's a 7-year ARM is what they're looking at. The 6 is it adjusts every 6 months, and so. For this, after this first 7 years, right? Some people know it as a 7 and 1. The 1 meant 1 year. So 7 and 6, that means that after the 7th year, it'll adjust every 6 months. Plus, you're going to get $15,000 in additional closing costs. These are incentives for new construction. You can see we have another site. First year rate is at basically 4%. And the APR on that one, after it adjusts to a fixed rate, then becomes probably something that's going to be a little about, what is it? I think it's 5.5%, I think is what it rolls out to. Anyway, then of course, we've got another builder that's offering holiday things and up to $50,000 in total credits. Now, super interesting. This is super, super important for anybody looking at new construction. This is the time of year if you're going to consider new construction. As you can see, there are tons and tons and tons of incentives out there that people have that are provided to you, whether it's improvements, whether it's rate buy down, whether it's closing costs. They're going to adjust price very, very little. They need to maintain price stability, so they incentivize you in other ways. Well, that makes sense, right? Hey, if you're going to be in your house for 10, 15, 20 years, even 30 years or forever, if it's a forever home, right? If you're able to secure a super low rate, time is your best friend at that point. I'm just saying, that's something to consider. Why has new construction fallen, whereas the existing or resale side of things have continued to evolve more? Super simple. New construction plats, it's harder to find bigger plats. It's harder to find, places to build. So they have to go out further and further. One of the number one sites right now is out in Marysville. We've got, they've got a couple of 100 home plats out there, and it's super affordable. The takeaway is I-5 is a disaster between basically Pacific, the exit for Pacific there, all the way through. It's a parking lot. Oh my gosh. Yeah, you may be saving money on a house and you get new construction, but the trade-offs, man, that is brutal. I mean, that is brutal because it's got to take almost 40 minutes to get through there on a bad traffic day. It's horrible. Anyway, I'm just saying. All right, moving on. So new construction, absolutely the best time to consider. Resales, again, this time of year, absolutely super awesome because sellers are very, very motivated. So I guess sellers are motivated on both sides. So let's get back to the chart. All right. So as we move on and let's start taking a look at some of our velocity, right? That's actually a close-up of that chart. And as you can see, average sales price right now is $912,000. Average list price is $1,051,000. And we haven't seen much of a change at all from last month. On new construction, here we go when we talk about actual sales volume. Okay, so here's the funny thing. Look, they're up 14 homes year over year for total closed sales, which is peanuts. Total pended year over year, they're up 181 homes. Not a big number. Okay. The month stats, when we take a look at it, solds actually are down almost 20%. And that's super shocking, really, if you think about it, with all the incentives and mortgage rates and whatnot. But wait a second, that's right. We have a lot of resale homes that is pulling buyers away, right? But pendeds are up almost 29%. And again, as you can see, those numbers are just super tiny, right? Let's get into bank-owned homes. Now, here's the thing. It was a strong recommendation that I not call out the number of people on the wall on shame. I will noodle on that one, so I did not put it in this one. I will tell you that there are, again, 17 people on the wall of shame. I'm sorry if some agents get upset. No, I do not share the information, but I do let them know that they are misadvertising their client's property. So our numbers, again, are going to look a little bit higher, but we need to take 17 off on the actual overall inventory. All right. So when we come back, we take a look at our chart here. Super simple. When you take a look at them, it's kind of funny. So even though it says we have 106, it's actually less than that, right? It's actually like 89, right? Because there's 17 more than should be there. All right. So at that rate, our number of foreclosures is super low. When you take a look at just the month of November, and people are like, oh my gosh, George, look at your chart. It's almost 43% higher on solds. And oh my gosh, you're almost 100% on pended. Look, man, when you increase something by 3, if you only have a total of 10 and the difference is 3, that's a big deal, right? Okay, it's not a big deal. Those are just peanut numbers. Nothing is super exciting on that at all. Foreclosures in our area, because again, we're one of the top 5 sweet spots across the United States, super low. And people are saying, hey, is there an increase in notice of defaults? I can say that our defaults have ticked up ever so slightly, not a ton, very, very small, which means that will they see, because we do not get a notice of default publication, we only get a notice of trustee sale. And so therefore, we only know once the bank has made a decision after they've defaulted, typically 90, 120 days. But there's a lot of workout programs still available for them. And again, why we're not going to see a shadow of inventory, we're not going to see a lot of anything as long as our inventory stays super low. Okay. Heck, we just did a valuation for a home going on market with a client of ours in Woodinville, and there's one overpriced home for sale, and that's all it's been for the last 60 days. So there's not a ton of inventory out there that is available. There's a lot of options that are available for folks, both in new construction and resale, with interest rates being very favorable or average. They're average right now, guys. So anyway, with that, hope you guys have an absolutely fabulous day. It's rainy, it's wet, stay dry. I will see you guys on the next video. Make sure you like and subscribe. Make sure that you let everybody know, share this video. And more importantly, let YouTube know, because I truly appreciate it. Let them know that you like it by hitting that like button. And I'll see you on the next video. Take care.